Hello, hello. Hi, Moses. Thank you for the like. I was waiting for the usuals to get here. We start in 4 minutes. Okay. All right. So we start in about 3 minutes. I'm waiting for the usual people to come in, and also we officially begin by 11 p.m. So there's that. In the meantime, I'm just going to keep looking at charts. Harmonic FX, thank you for the follow, and thank you for liking the live. Let's see who's all in here. Where is it? Big Identity, hi. King Khalif, MacB, hi, you're welcome. Big Identity, thank you for the likes. We start in a little over 3 minutes or under. Let's see. Starting in 2 minutes. Viewing options. Let's get rid of that. Yeah. Okay, that looks interesting. Same deal with EU, isn't it? Pusa. Bawoni. Yusufa, welcome to the live. Dean, welcome to the live. Trading King, EAA Eric, hi. McBee, you're welcome as well. We start in Mwapao. It's what way you come today. Probably confusing the shit out of y'all. Yeah, Musa, thank you. EAA Eric, how can I stop looking at normal candlesticks? You don't have to stop. If you don't want to, you don't have to. Okay? I'm looking at normal candlesticks right now. They're actually pretty useful because you can see fair value gaps and stuff on there. So for me, like the high time frame. Vosa, thank you so much, Jerry. I appreciate you. Thank you. The high time frames, okay? This is a monthly chart right now. What I'm doing is flicking through monthly charts. The high time frames are extremely valuable. For instance, this here, this is a fair value gap. So I'm anticipating if the market hits this point here, we should have something dramatic. Even if it's only a small pullback, remember it's a monthly time frame, which means that you're going to get something, even if it's just 50 to 100 pips, probably more actually. Let's see, it's 11 p.m. We have 11 people in the house. We're just going to get started right away. I will not be paying attention to comments at this time. Please be careful, and there will be strange people offering you strange things like crypto and signals and whatever. I do not endorse those people. If you see anyone in the live who's using my profile picture or whatever, that's not me. This is my only account. So let's get going. As usual, I start by talking about the story of price, which is liquidity. So let me grab this on here. See, first of all, I would like to switch to a different, let's use UJ. Perfect. Looks like it might be a bullish month. Okay, so as usual, I like to start by telling you the story of price. And why do I keep calling it a story? Because it's a story. Because you don't have to change your trading strategy in order to apply this. What the story is going to show you is when to get in and where to get out. So it will refine your entries and your exits and show you on time when you are wrong about a trade. So just quick little intro for those of you who don't know who I am. Hi, my name is Nessa. Also, I take tics on TikTok. And I have been a trader for the past 10 years, and I failed successfully for 9 of those years. It was horrible. It was grueling. I lost lots of accounts, lots of money. And I promised myself that as soon as I figure this shit out, I'm going to come back here and make it simple, because most people, it's not that they couldn't possibly succeed, it's that there's too much information. So one of the things that I do is I peel back all of that crap. I try to not fill your mind with too much stuff, okay? So I stick to what's just the basics, what matters. Because with that simplicity, you're not confused about what you're seeing on the charts. Everything I'm going to teach you today is not of my making, all right? Look at me. Everything I'm going to teach you today, I did not create personally. It was created by Michael Huddleston, who's also called the Inner Circle Trader. Some of you know him better as ICT. Some of you have seen videos by Aman that talk about how he's a scammer. Okay, not going to get into that. I'm always a believer in the fact that if someone's telling you something, go and test what they say, because a broken clock can be right twice. And he teaches about liquidity. Okay, the thing about ICT is his whole body of work is extensive. There's so many things to cover there, and it can be very confusing if you're trying to learn every single thing. So the mistake I made when I came into trading was I was trying to learn everything, and of course that confused me. It took me a while for me to recognize, no, you don't need too much. You just need maybe 1 or 2 things tops, and then you'll figure it out. So that's what we're going to do today. We're going to talk about liquidity. Hi, Freddie, I see you. Okay, so let's flip this thing around. And let's get started once more. Down, 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 down. So we'll make that visible. I don't like what I'm seeing. Okay, that's much better. So, liquidity. Getting rid of these period separators because I need you all to see what I'm typing. What exactly is liquidity about? Liquidity is money. That's all it is. So if you've ever been on an ICT lesson or something, you're watching a video on YouTube, you're watching all these YouTubers talk about liquidity, they're just talking about money. Let's keep it simple. It's money. Everything that you see on the charts right here, this is a monthly chart for USDJPY. All of this movement up and down is just money moving from one spot to another spot. And your job as a trader is rather simple. And I'm assuming that I'm addressing people who are not brand new to trading. So this is the thing. Once you figured out what the trend is, okay? Once you figured out what the trend is, let's write that out. Once you figured out what the trend is, your job as a trader every day is to ask yourself 3 questions. Number 1, where is the money coming from? Number 2, where is the money going to? And number 3, is there enough room for me to take some for myself? Every day. These are the 3 questions. If you can't answer these 3 questions, you have no business trying to trade. If you cannot answer these questions, you have no business trying to trade. Trying to answer these questions before anything else will keep you out of losing trades. But then the question is, what the fuck am I talking about in the first place? So the thing is, for you to be able to answer these questions about the money, remember, about the liquidity, you need to understand something about the range. So what is a range? Now, typically, when you hear the word range as regards trading, you're thinking about the Asian session range, London session range, New York session range. You're thinking daily ranges, weekly ranges, right? But I'm here to simplify things for you, because if you're listening to those definitions, it's like there's so many ways you could define a range, right? I have decided to make that thing simple and just say, as I always say, a range is the distance or area between 2 price points. That's it. So let me pull up horizontal lines as usual. Those of you who know, you know already. Let's change these colors up here so that they're more visible. Make that red. Oh, that's such a dim red. And then make that, yeah. So look at these 2 lines on the chart. They're really close to each other, right? Even if they are just 1 pip apart from each other, the space in between them counts as a range. The trouble is, obviously, you cannot trade a chart, or you cannot trade a range that is just 1 pip. You need more than a few pips for you to be able to make money. That's why I have this third question here. Is there enough room for me to take some for myself? Is there enough room between these two places, is what I should say, between these two places for me to take some for myself? Very critical thing. So when you have a range defined like this, you just know it's two different price points. They could be 1,000 pips apart. They could be just 10 pips apart. I don't care. It's a range. So with this definition in mind, let me zoom out and let's take us to a 4-hour chart. Okay? So what you're looking at right now, hang on, I'm trying to find my notes so it's easy. Let's grab the daily. Where is my notes? So I have to go back to the monthly and then bring it back to the current price action, then go down to the 4-hour, scrunch up my charts, whatever. We'll go back to the notes later. But look at this. Every single candlestick, as you already know, has 4 different price points. Well, most candlesticks anyway. For a bullish candle, you know this, the open is beneath the close. So you have the open, you have the close over here, you have the high, you have the low. For a bearish candle, same deal. So this one doesn't have a wick. Let's look for something that's clearer. You have the open, you have the close beneath the open, you have the high, you have the low. 4 different price points. What this means is you could decide, and now what we're talking about is how to define a range. You could decide to pick any of these price points, 2 of them, and make that your range. Okay? So let me go back to the monthly chart where my notes are. Over here, and type this. How to define a range. Okay, so let's talk about the different ways to define a range. Different ways to define your range. So way number 1 is using a single candlestick. Now, this is a monthly chart, okay? Let's zoom in, let's make everything tight and close. This is a monthly chart. This is a high over here. Let me change the color so you can see it clearly and make that thick. I'm looking at this candle here. This is a high and this is a low. There, boom, you have just defined for yourself a range with one single candlestick. If you wanted to use this other candlestick here, whatever, this is it. Okay? You have yourself a range. You're just using the highs and lows. Now, bear in mind, this is a monthly chart, and the reason I keep repeating this is because if you are using like a 1-minute chart to measure ranges, you'll find that, look at this candlestick here. Let's measure from the low to the high. All of this is about 830 something pips, right? So let's go down to a regular time frame chart. Let's go to what you call it, a 1-minute chart, USD JPY. Give me a second. Let me open that up and let me switch templates. So let's go to USD JPY. This is what we're looking at now, and I'll take you to a 1-minute chart. And what I'm going to show you is a candlestick that looks relatively the same size as this one over here, right? Let's look at this one. This one even looks bigger. If I measure from here to here, you have only 7 pips. So there's not a lot that you could do with 7 pips unless you are a scalper. A scalper is someone who just comes into the market. You're looking to take anywhere from, for me, my personal definition of scalping, anywhere from 2 pips to like maybe 12 or something. That's for me though. You could maybe hold for longer, I don't know. So the whole point of it is when you are drawing your ranges, you're marking your range, it is important to use the high time frames or what I call high range frames. And I'll talk about that in a second. Like I said, this is a monthly chart, so it's a lot. Let's take a look at, this is the M1. We've talked about why that's not convenient. If you go to a 15-minute chart, pick any random candle, doesn't matter, it is a range. All candlesticks are ranges rather, because you have a high and a low. Some people will use opens and closes. I don't care about that. I don't use opens and closes. I haven't tried that. If you want to experiment with that, you're more than welcome to. But I use the high and the low because I like to use the entire candle. Now, if you were paying attention, you noticed that I said use a high time frame. So what counts as a high time frame will depend strongly upon whether you are using an asset that has high volatility like GBP CAD. Let's go for example. Let's take a look at everything that happened on I'm going to make 2 comparisons for you to understand what I'm trying to say. So let's look at the Aussie CAD first. The Aussie CAD today, how many pips did it move from its high to its low? So from here to here, that's just about 53 pips for Aussie CAD, right? Compare that to GBP CAD. So this is GBP CAD. And from the high to the low, you had 96 pips. You see how that's different? So you have to be mindful. If you're going to use something like the Aussie CAD, for instance, your definition of a high time frame would be different to GBP CAD. So for instance, GBP CAD, I consider anything from H1, this is the H1 chart, the 1 hour chart where every bar is worth 1 hour of price action. I would consider this as a high time frame. Why? Because I'm seeing enough things for me to take advantage of in here, which I will show you shortly if you don't already know. Those of you who are regulars, you already know what's up. You can already see things like the order block and how the market gave you enough pips, at least 35 or something in this particular instance, right? But if you're using something like Aussie CAD, AUD CAD, this is the same 1 hour chart. It's not like there wasn't stuff to take advantage of, but it didn't give you too much. And I would much rather, if I'm dealing with pairs that don't move a lot, I would much rather look at the 4 hour and above. Okay, so if it has high volatility, a lot of movements every day, I look at H1 and above as my version of the high time frame. And why is it important to look at the high time frames first? To work your way down from the monthly to the weekly to the daily, etc. Why does it matter? Because everything that you see taking place on a 1 minute chart, a 5 minute chart, 15-minute chart, whatever, they all take their marching instructions from those higher time frames. Sure, the move for a reversal or pullback or whatever could start from the 1 minute, or heck, you want a 30-second chart? Cool, no problem. It starts from there, but it's starting from there because it is reacting to or responding to something on a high time frame. So if you are the kind of person who you just keep your trading to one specific chart, it's not like you can't make money doing that, but I'm asking you to consider taking a look at what happens on the high time frame. All right? There's always advantages to be had there. So let's take us back to the, I think I'll just keep Aussie CAD for now. So for anything that doesn't move a lot, H4, day one, weekly, monthly. Anything that moves a lot, you can extend that high time frame, whatever, to H1 as well, because it's sure to give you something, okay? I also mentioned something about high range frames. What do I mean by a high range frame? Now, there are certain charting methods that do not require price or time-based candles. So these candles are time-based. Each one of these bars represents 4 hours of price action. So if you mark this high and low there and you go down to a lower time frame, you start to see all of the stuff like an X-ray, like you get an X-ray of what exactly happened within this candle on the lower time frame for 4 hours. But if you don't want to use time-based charts, and there are reasons you may not want to do this because there's a lot more clarity offered with the kinds of charts I'm about to show you. You can use a price-based chart. That's what I mean when I say a high range frame. So let's talk about it. Let's see. Let's talk about the first one, which is the Renko chart. So I'll take you to a 25 pip Renko bar chart. You have to wait for a little bit because it needs to populate. So as you can see here, this is a Renko bar chart. How it's different from your usual time-based chart is, first of all, each of these bricks is worth 25 pips. That's thing number one. In other words, if it takes 10 years for the market to push from this point to this point here, then it takes 10 years before you see this brick close. Okay? In other words, it compresses or eliminates totally the idea of time and focuses only on showing you pure price action. The thing you should also note about Renko bar charts is this. Just because this looks like very clean price action doesn't mean that's the case. So let's look here. You have this candle that closed bearish, and then what? It opens down here. So why do you not see anything down here? Because the market may have pushed a little bit to the downside, right? But you're not going to see that on a Renko bar chart. You're not going to see it if it did not push all the way down to make another 25 pips. Instead, it pulled back by 25 pips and then pulled back another 25 pips for a total of 50 to be able to form this bullish chart, this bullish bar here. Once this bullish bar formed and closed here, this one opened. But that does not mean that the market just went straight up. It could have, but the odds are it probably didn't, because what you will notice is probably you'll find when this guy opens here, It may push up and do whatever, then it may pull back even as far as 24.9 pips, but it didn't make it to 25. And you won't see that here. You won't see it unless it gives you that 50 pip reversal here, but instead it pushes up later on for 25 pips. So let's see if we can find an actual example of what I'm saying so there's no confusion. So let's take a look at the most recent price action here and see if we had a shoot downwards straight away from this price, or if the market actually pulled back a little bit. So I need you to note the high and low of this. I'm going to go down to a regular time frame chart. That's a 5 minute. Okay, so this area here, this is where this 25 pip Renko bar closed. And this is the same area that the next one opened. And in this case, look over here. What do you see? This is the open. The open price for the previous one, the close price for the previous one is the same as the open for the current one. And notice the market pulled back by about 5 or 4 pips. But you will not see it on this chart here. You won't see it because it did not pull back significantly enough for it to print another bar. So that's how it cleans up your price action. So when I talk about using a high range frame in order to determine your ranges, or a high time frame in order to determine your ranges as well, I'm asking you to do this because remember, we have this question that needs to be answered here. This question, which is there enough room between these two places for me to take some for myself? Well, some of what? Some of that money. What is the money again? It is liquidity. So I've said to you that you can define a range with a single candlestick. I've shown you can do that with a single candlestick, whether it's the monthly chart, a weekly chart, daily chart, whatever. You can also do that with a Renko chart. As a matter of fact, you can simplify your trading by looking for a high range frame. What do I mean by a range frame? Number of pips. So not time frame, range frame. Because this is Aussie CAD, 25 pips is high enough. Or you could go a little bit higher if you want to. So this is one form of a different kind of charting technique that does not involve time, that cleans up the price action. Let me show you another one. Let's go to a different chart now. GBP, let's do JPY, sure. So this is the dragon. And this is the dragon with that 25 pip Renko bar chart. Notice all of this price action, okay? And then I'm going to switch to a regular time frame chart so you can take a look. This is all that price action. Notice the difference. Notice how clean it is when you're observing with the Renko bar chart. Now the next bar I'm going to introduce you to, the next range bar, is literally called a range bar chart. So I'm going to take you to, let's take a look. Let's see. Let's start with the 20 pip range bar chart for the same thing here. So you have to give it a bit for it to populate. And boom, this is it. Not as clean. I typically prefer 50s though. 50 is a high enough range for me when it comes to trading anything that moves a lot. And for those of you wondering, what do I mean anything that moves a lot? Take notes. GBP CAD, GBP JPY, GBP AUD, Euro CAD, and Euro Aussie. So these 5 pairs, also the pound Kiwi, and the Euro Kiwi as well. So Kiwi's NZD, EUR NZD, GBP NZD, GBP CAD, GBP Aussie, GBP Yen. All right. And Euro Aussie, Euro CAD. So these guys, they move a lot. And for them, my definition of a high range frame is the 50 pip range bar chart. That's high enough for me. So take a look at this. All of this price action is what you saw here. Notice how clean it is. The difference between a range bar chart and a Renko bar chart is for the Renko, you don't see any wicks, but for the range, you do. For the ranges, when the price has made a low, in the case of a bullish bar, from that low, you would measure all the way up to whatever you set this to. So like this chart is set to 50 pips. Until the bar has moved 50 pips away from that low, you will not get a closed bar. Same thing for the bearish. Until the market has moved 50 pips from that high, you will not get a closed bar. Why do I sometimes prefer the range bar chart to the Renko? It's because it makes it easier to see things like swings. So we'll talk about that later. But in this case, like I said multiple times, you can absolutely use a single bar as your range. So you have a high and you have a low. Let's come back to our notes and talk about why it's important in the first place. So we'll talk about single candlestick. The second thing I want to do is show you the second way, actually. Let's talk about that first. Using swings. Okay? So let's talk about what a swing is. A swing, I'm trying to type that, is the turning point in price. So remember at the start of this, for those of you who have been here, I always repeat that I am telling you a story about price. You have to stop thinking like how do I put this? Don't think too rigidly about the market. Don't think of it too, oh, you're just focused on strategy. If you understand the story behind it, then whatever strategy you're using, you can keep that. You can just apply the story to it. So think about the meaning of the word. When you're telling a story or you're listening to a story, the meanings of the words matter. So pay attention. I've told you a range is what? The distance or area between two price points. So that means automatically, even if I don't show you a certain way for you to mark a range on your chart, you have the option of creating one yourself other than something that I've shown you here. So the next thing is we're talking about how to use swings to define a range. And I've said that a swing is the turning point in price. Think about what a turning point is, what it implies. So let me show you that over here, right? You're looking at, let me delete these, don't need them, get them out the way. When we say a swing is a turning point in price, the implication is simply the market. Look at this here. We started moving down. That was just a retracement. You know it was just a retracement because we didn't push any further than that. And then eventually it went up again. So this literal point here from where the market turns is how you start to identify your swing. But here's the thing now. It's a 3-candle pattern. So for a swing low or a bullish swing, if you want to call it that, you have 3 candles. The middle candle has the lowest low of all the 3 candles. So you have a higher low here, a higher low here than this one, and all of that makes that swing. That is the turning point, okay? If you think about what you've been taught about head and shoulders patterns and inverted head and shoulders, inverse head and shoulders, you'll realize that what you're seeing is a compressed version of that. And because this is a high time frame, you're more likely to get some sort of movement to exploit anytime you see a swing. Remember I said this is USD/JPY on a monthly chart. It's a monthly chart, which means that a monthly swing has great significance. Look over here as well. And this is my growls personally with time-based charts. But this is 1, 2, 3, a swing. By the time the swing has formed, it's a little too late. But then it is a swing. Look over here as well. What do you have? 1, 2, 3. That's a swing. So I just showed you a swing high over here. I'll show you another swing high. 1, 2, 3. Does this mean that you should go trading every swing you see? No, that's not what it means, because that's a good way to have your butt handed to you. Instead, we're talking about how to define a range using swings, right? So if a swing is a turning point in price, let's check this out. The market was coming from down here, from up here rather, and it pushed and made its way down here, created this swing and started to push on up. So what can we do? Let me grab my rectangle. So one thing I can do is I can note, okay, we were coming from this high and then we got to this low and that's where we turned around. So now what have I done? I have defined myself a range. This is a monthly chart, mind you. I have defined myself a range, just going from one swing to the next. If I were to use a range bar chart, same deal. This one's a little bit messy right now. Let's check, let's see. Okay, darling, come here. Give it a second for it to populate. This is GBP CAD, 50 pip range bar chart. It needs time to build. All right, finally, there we go. So if you are using a range bar chart to define your swings, how could you do that? Let's see. What do you have here? This is a high, a lower high on either side. So, okay, that's the starting point. And then you're paying attention and you're noticing the market finally pushed into this area and made a swing. So you could have marked that out. But in this case, the range you would have marked out it would have been broken. And guess what? It's not the end of the world, guys. So there's something that I typically say every live, and it's this. It is that everything that you are taught, whether it's from me or somebody else, when it comes to trading, nothing works 100% of the time. If you're looking for something that works 100% of the time, you are in the wrong line of business. You are in the business of probability, exploiting probability. What do I mean? Probability of something playing out over and over again. So I'm showing you things that play out often enough for you to exploit. If you're looking for something that works 100% of the time, I am not the one. I will not sell you that lie. I do not want to sell you that lie. When I first came into this business, I thought to myself, oh, there must be some holy grail, some type of never lose method. I'm telling you right now, it does not exist. And anybody telling you that it does exist does not like you. Or they are completely new and have no idea what they're talking about. Okay? So in this case, you have yourself a range. How else could you define a range? Look at this. This is another swing here, 1, 2, 3. That's the low that's been created. And then the market starts to push up, and then it returns back with a 1, 2, 3 pattern. So now I'm marking this high here down to this low here. We now have ourselves a range. Okay? Now, let's go back to our notes. You now know how to define ranges, but the question is, why is it even important to have a range in the first place? There are 3 important price points in a range. Okay? The first one, you have the premium. No, let's start with equilibrium. Number 2, you have the premium. And number 3, you have discount. Okay, so let's talk about them. When you hear the word equilibrium, it simply means balance. So let's talk about what that means. Coming over here, and let's put a regular price chart. So this is GBP CAD on the 4-hour chart. Let's pick this particular one. Yes, I'm cherry picking right now, but don't worry, we'll talk about how it does not have to be that way later. So we've picked this bar. In this range, okay, the 50% point, the halfway point, is called equilibrium. Equilibrium is just a word that means balance. When everything is balanced, the buying and selling activity is at a balance. There's an agreement between buyers and sellers that, oh, this is a fair price for the asset. It could be there. But you know, the thing about the market is it's always moving. So that agreement is not going to last very long. Okay, keep that in mind, which is why you don't want to be making entry decisions around the equilibrium unless you're planning to give more than enough room for the trade to play out. I'll leave that at that. Once you have the 50%, everything from that point to the downside is called the discount. The discount portion of the range. Think about the meaning of the word discount. So you have your favorite video game console or whatever, and you go to a store and you find out that it's being sold at a discount. What do? Immediately you want to be a buyer. And then if you have noticed you're trying to get into business and then you realize, oh my God, this particular item would be awesome to sell because it's a premium item. I'd make a lot of money from it. What do? You sell at a premium. So the premium is everything from 50% and up. Above 50%, that's your premium. Below 50%, that's your discount. Now I need to add a caveat. I started at the beginning of this by saying that the first thing you must do before asking those 3 questions is to define what your trend is. So you come here now, let's zoom out and observe what's been going on. Look at this. It's been nothing but bearish action. The pullbacks, the bullish pullbacks, they're not as intense as the drops to the downside. That automatically tells you what? That you should be looking to be a seller. So when you have something like this, you only want to sell the premium portion of the range when you are in a bearish trend. You have no business selling it in a bullish trend unless, and this is the caveat, unless you are in a bearish retracement within that bullish trend. So let me explain. I'll take you up to, let's start from the, okay, that monthly is going to take us too far back. Let's use maybe the weekly. So take a look. This is a weekly chart, right? Zooming in here. In this particular case, you can see that we've been pushing up. This is a perfect example, actually. We have been pushing to the upside. Look at this. Up, 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 up. Same pair, GBP CAD. But right now, we are in what looks to be a retracement. So on the weekly chart, it may not seem like much, but once you've established that this is a retracement, and what's one way you could do that? Look at this, 1, 2, 3, that's a swing. What did we call a swing? The turning point in price. What did we say about swings? We say there's a chance that if the market forms that swing on a high time frame, it may want to continue to push in that direction, if only for a little bit. So this is a weekly chart. What looks to be just a simple retracement on a weekly chart, over on the 4-hour, here, as I scrunched up my charts and showed you, it looked like we're just trending to the downside. Okay, so in that situation, that's the only time you'd be allowed to sell a premium if you've noticed from the weekly or a higher time frame that, look, it appears that we are in a bearish retracement within a bullish context. But you must always be mindful, because at any point in time, this may not turn into a reversal. The market may actually turn back around and continue that bullish trend. Okay, so let's come back to what we're talking about here. 4-hour, boom, here we go. GBP CAD H4. Not that it matters, because price is price. Those of you who keep asking me, these concepts apply across different, yes, they do. They do. I don't care what you trade, even stocks. Just yesterday we looked at Amazon, same thing. Just that I would not trade stocks because those gaps are ridiculous to me. But anyway, look at this here. In this case, what do you want to do? You want to be a seller in the premium portion of the range. Okay? If you are in the discount portion of a range, you should only buy when that trend is bullish. The only condition in which it's okay to buy in a bearish trend is if you have established on a high time frame that while you're in a bearish trend, you are also experiencing a bullish retracement, a bullish pullback before the continuation of that bearish trend. And in these situations where you are making trades that are counter trend, I advise you to be really quick about taking your profits. Okay, since this is GBP CAD, this is H4, it's GBP CAD, it moves a lot. You can actually get a lot out of this single H4 chart. You can get a lot from it. But if you're using something that does not have a lot of range, I'd advise you, like, once more, please try to always just start from the monthly. It's not going to kill you. And by the way, I need you guys to think about the fact that in about 27 minutes, you are going to be at the start of a new month. So go to your monthly charts and start to mark what's happening there. Mark the highs and the lows. Mark the other things that I'm going to show you as well. So what other things? Let's talk about it. Let's come back here. When it comes to liquidity itself, now that you know the different areas in the range, we have to talk about liquidity. What are the kinds of liquidity? There are two primary kinds of liquidity, not the official spelling. I just use the consonants in there. So now, number one, you have external range liquidity, which is money outside the range, okay? And then you have number two, internal range liquidity, which is money inside the range. So when it comes to external range liquidity, those of you who are familiar with ICT's work, he talks about relative highs and lows. He talks about weekly highs and lows, monthly highs and lows, whatever. We can just simplify that by saying you'll find it at highs and lows. I'm not going to confuse you with all of that intermediate swing high, intermediate. No. We're stripping everything down to the basics. So you have your highs and lows as where you can find money outside of the range. And then for inside of the range, you have two primary kinds. There's more than that, to be sure. There's more than two. But remember what I said at the start of this, that my goal is to simplify things. A lot of you, the reason you know so much and you still keep losing is not because you're stupid. And it's not because you're a dumbass or something. It's just because you know too much. It's too much. So on the same chart, you're looking at multiple reasons to be a buyer and multiple reasons to be a seller as well. So the purpose of this live is to help you strip everything down to the basics. So when it comes to internal range liquidity, you have the order block, which can be bullish or bearish, and then you have the fair value gap. I'm very deliberate about not talking about anything else because it just comes down to these two, as far as I'm concerned. Okay, so let's talk about how to identify your external range. Is simple enough, which is basically this. In this case, this is GBP CAD H4 once more. Take a look. What you have here is a high and a low, which means There's money resting at highs and lows. Let me take you back to our image of trends. Hang on a second, I have to stretch it. Remember, we keep talking about a trend, so this is a portrayal of the bullish trend, right? Remember what you've been taught? That basically, anytime the market's in an uptrend, we have this low, it pushes up, the pullback is not as intense as the uptrend, the push up here, and then you have another push to the upside, breaking this high. So in an uptrend, highs are being broken consistently, while the lows are typically respected. I don't say typically for no reason, I say typically because sometimes they're not, and it's still an uptrend. My point is this: when you get into this trade here, get into a trade here, where do you place your stop loss? You're taught to place it at a low, right? You're taught to place it here as well. And on it goes. When the market pulls back, retraces, and begins that continuation, you're in a trade, your stop loss is at the low. But sometimes you will have shit like this, where the market pushes down and actually disrespects a low. But why is it doing that? And then you're convinced that, oh, this is supposed to be a sell. Excuse me while I got my... Ooh, that got scattered. Come back here. So you're over here convinced that, oh, because this low has been broken, now you're supposed to be selling. But what you don't realize is, no, it's just that the liquidity here, the money here, what is the money? Your stop losses. Because your money doesn't just disappear into thin air when your stop loss is hit. If you're losing, someone else is winning. So they brought this down here and they've tagged your stop loss. And then you're thinking to yourself, oh, wait, we've been taught this is a breakout. Sell the breakout, guys, sell the breakout. And then have your stop loss at where? The high. But then what happens? The market turns around and boom, takes out that high as well. So now you're left scratching your head, not realizing that the uptrend is not quite done. Why is this relevant? So then how do you figure out when the uptrend is done? Look at that same situation here. You have this low, it gets broken. But in this case, you have a new low now. So you're watching this. Is it going to take off and break the new high? Well, what happens? The market pushes up, it stalls for a bit, it's unable to break this high, and then it pushes down and breaks this other low. And it is from this point here you could say there's a higher chance that this is not just a pullback. This move here was not just a pullback, but an actual reversal once you have this low broken here. And then now you can keep going. And the same scenario happens even with the bearish trend, where you can have a high. Typically, the highs are supposed to be respected, but then what happens? In this case here, you have this break. People are thinking, oh, breakout, buy, buy, buy. And they have their stop losses here. Also, the people who sold here, they've gotten taken out. And you enter that trade thinking, oh, yeah, we should be buying. And then it turns around and takes you out. Why is this important? Because that's the play for money outside of a range. Think about this. When the market has formed this turning, what did we say a swing is? Turning point in price. So this is the start of that range over here. Then the market came here and did what? Turned around. Okay? Now you have defined a range for yourself. Now what happens? In this instance, the market came and took money that is outside the range. All right, because there's liquidity here. What did we say the liquidity was? Your stop losses. Hang on, let me stretch this. Your stop losses, which are resting above this high. That's the money outside the range. So now this is the point where I say to you that you don't have to be someone who trades everything. You can choose to be one of two kinds of traders. You could be trader number one, who looks for external range liquidity and trades that back into the range and maybe beyond. That's trader number one. Or you could be trader number two, who after drawing their range like this, right? This is just an example. We'll get into actual ones on the chart. Who after drawing their range like this, and why would they draw their range like this? Because this is a turning point. This is another turning point. Great. Box that shit off. You could be the second kind of trader who looks for, since this is a downtrend, you're looking for anything above 50% within that range to take money from inside the range to the outside. I'll take that again. You could be the kind of trader who, once you've defined your range like this, all you're doing is you're setting an alert for the high because this is a bearish trend. You're setting an alert for the high because you want to see if that high is going to get tagged. And if it does get tagged, then you would go to a lower time frame and take a sell, or you would wait for a swing formation or whatever it is you typically use to confirm a sell trade, even if it's just your basic support, turn resistance, whatever it is. That is what you would use to get in, and then you'd be looking to target at least 50% of the range or just below there, since you expect buying activity. Or as you're approaching 50%, put an order, or rather put an alert there, so that you can take something off the table, move your stop loss to break even, see if the market's willing to give you some more. That's trader one. Trader two is the kind of trader who draws their range like this. Hang on a sec. Okay, from this high to this low, and they're looking for something inside of here above 50% because it's a bearish trend. So they're looking for something in the premium portion to use as their excuse to be a seller. Let's do it for the flip side as well, and then I will show you actual charts. So again, I say you can be one of two kinds of traders. The first one, let's see, what do we have here? We have this low, and then we have this high over here, right here. So let me pull that up. You could be the kind of trader who seeks the market to take out a low. You're waiting, you have an alert for it. You've made your range low, range high. You're waiting for the market to come outside of the range. And now you're going to take that money from outside of the range and go in. So this is the part where I keep saying you don't have to change your strategy. If you guys use just a simple break in market structure, a trend line break, resistance turn support, whatever it is, you can use that. But now you're going to get something more accurate. You can use that. If you want to, even, you could say, okay, you're going to wait for the money to get back into the range from this outside, and then look for whatever it is your entry criteria is, and then you're in a buy. That's trader number one. Trader number two is the kind of trader who just marks the high and the low of a range, like so, and then, let's pull this properly. And then all you're looking for is for the market to retrace just below 50%. And in that portion, that discount portion, they're looking for reasons to be a buyer. So what are these reasons inside of the range I keep talking about? Because I said liquidity exists at highs and lows for external range liquidity. But what about internal range liquidity? Excellent question. Let's go off to a regular chart and talk about it. For that, let's go to any random pair, maybe USD CHF. I haven't looked at that in a while. And maybe a 5-minute. Okay. So I'm about to show you the two different kinds of internal range liquidity, starting with order blocks. So look over here. We have a high. Why is it a high? Remember, this high is lower than this high. That's a swing high, right? We were pushing down coming into here. This high gets broken. As soon as this high gets broken with a close, why a close? Because we're in a low time frame. If it was a high time frame like a weekly or a daily and it wicked through, I might count that as a break. But if it's a low time frame, because the low time frames anything can change at any point in time, I need the confirmation of an actual close above this high. So as soon as this happens, the last bearish candle that sponsored this move to the upside, that broke this high, that candle becomes your order block. So I'm going to mark it like this. Some people will mark it from the low and then use only the body. Okay, in this case, it would have played out. Others, like me, will use the entirety of the wick. The only time I would ever drag it down to the body is if I see it's a really large order block, so that there's a chance the market may really retrace even lower than where I think it should. So here, this is your order block, like so. Notice what happens. When the market broke this high, this became the order block. And what happens? The market returns to it, taps it perfectly, and then takes off from there. And your target could have been this high. Now, this is a 5-minute chart. So the movement was only about what? If you're trading to this high here, that's about 13 pips. But I need you to imagine what happens when you apply this to, I don't know, a daily chart or a weekly chart. That's hundreds of pips potentially. And you're not looking, unless you are a position trader. I'm not speaking to position traders here. I'm speaking to scalpers and day traders and maybe swing traders. Unless you're a position trader, that should be more than enough for you to take something for yourself on those time frames. So this right here becomes a bullish order block. If the candle before this one, this order block was also bearish, okay, you would go ahead and highlight that as well. But in this case, that's not the case. And notice how, let me explain exactly what's going on with an order block, right? The big boys, the big gals, the hedge funds, the central banks, and quote unquote, whatever, they're the ones who actually move the money. You and I were just small fish or small fry, okay? We're just trying to ride on whatever it is they're doing. So if they were to put all of their orders here to send the market up, what would happen is the market would shoot straight up and it would be too obvious and everybody would jump in and everybody would make money. And of course, we can't have that because, like it or not, this is an ugly business. If someone is losing, if you're losing, someone's winning. If you're winning, someone's losing. Okay? So they can't have that. So instead, what do? They'll put in just a little bit of their orders, just a little bit, not the full thing. Then they allow the price to travel up like that. Then they start to sell it back down into here with the intent of putting the remaining of their orders in here, into this block. Okay? And then they came back one more time, because they were not done filling it. So sometimes they'll revisit it multiple times. I prefer fresh ones though, but that's just me. So this is a bullish order block. Now, the other thing that I'm going to teach you right away is a fair value gap. So pay attention. You have this high broken. As soon as this candle closes here, you will notice that there's this low, the candle's low, and then there's this other candle's high. Between these two places, all right, let me drag my cursor, drag the square there. This area is an imbalance. It is the fair value gap. That's what it's called. Why is it an area of imbalance? Because there was nothing but just buying activity here, all just bullish shit. The traders, the sellers rather, they had no opportunity. So it's like when you're painting a wall, you know, this is an analogy that ICT gave. It's like when you dip your paint roller into the bucket and you put it on the wall and you paint to the upside in this case, okay? You will notice that while the paint, let's say it's a white paint and you're putting a fresh coat of white paint on a blue wall, you will notice that you're seeing the white, but you're still seeing some blue. So in order to balance that, to make it pure white, what do you have to do? You have to roll it back down. So this is that. You're painting, but this is just pure bullish pressure. We have to balance that. And so the market does what? Returns to this fair value gap to balance it. Now, sometimes the market will only touch this by a pip. It'll just come like maybe a tiny pip or a point below this low here and then take off running. Sometimes. Other times, it will region a little bit deeper. And I've said this before on maybe just one live, but if you'll notice, an FVG, which is the short form of a fair value gap, is in a sense kind of a range of its own. You can treat it as a range in terms of entries. Think about it. I haven't said this particular point before, but if you think about the fact that we have this FVG start here, FVG end, and that becomes a range for entries in particular. What is this? The discount portion of the FVG. Beautiful. So if you wanted to, this is a 15-minute chart, mind you. If you wanted to, you could have dropped down to the 1 minute and started looking for refinements for those of you who like your tight entries and stuff, but it's not necessary. If you don't like the idea of refining that, of looking for a break in market structure or whatever excuse it is you use to enter or buy, another thing you could have done is you notice this is a fair value gap. The market trades into it. Either you have your pending order here with your stop loss below the second candle or below the entire swing itself, just to be safe. Your other option could have been you wait. This happens. What is a swing? A swing is the turning point in price. So we're getting a swing that is rooted in a fair value gap. I've said before, one of my videos you may have watched before, I said if you pair swings with liquidity, you will have more accuracy than usual with your trades. So in this case here, what is a swing telling you? The price is now turning. So the odds are high that the market at this point should be ready to go. So by this candle here, you'd be entering. You could have your stop loss below the swing, or to be safer still below this fair value gap candle here, candle 2. And what would you be targeting? Very obviously, the most recent highs. Okay? So I have shown you a bullish order block, and I have shown you a bullish fair value gap. Let's take a look at a bearish version of these things. So let's see, this is USD Swiss. Maybe I could find something that is, let's take a look at NZDU. I know that was crapping itself this week. NZDU. NZDU is so beautiful this week. I can't. Okay. All right, I like this. So this is NZDU on the 15-minute chart, right? I think I'd rather use a 5 because I want to show you, but I don't want to confuse you with this. There's no actual swing, although there is a swing on the 5 minute for sure. Let's come here. Right. Like that. So take a look at this. What do you have here? This is a low. The low gets broken. Once this low is broken, the last bullish candle that led to the break, that is your bearish order block. Grab a rectangle and I'll show you that right here. Okay? Notice how it got broken. The market retraced into it, in this case, almost immediately, and then took off from there. What do you have here? This is another low that got broken. As soon as it got broken, this became a bearish order block. Once it broke, this became a bearish order block. The market retraced into it, did not go past it. So you could have like a pending entry here, or a pending order here, stop loss above the order block, or above this entire swing if you want to be safer. And then it goes down. What do you have again? Another break in structure. Here, this low got broken by this candle. As soon as that happened, this bullish candle became your order block. So what can you do? You could have a pending order here, your stop loss above the high or above the order block. That's up to you. And what happens? And if you're paying close attention, guys, in much the same way that I showed you that FVG is a range, you could treat it as a range when it comes to your entries. You can treat order blocks as a range too when it comes to your entries. Think about it. So in this case now, you've defined a range. You've defined a single bar here. That's the order block, right? What is 50% of it? This area here. What are we looking for? Something above it. So you could say to yourself, I'm going to have a pending order in the premium portion of this order block. Bear in mind that sometimes the market will not pick up your order because it didn't go far enough or because your spreads were a little bit too wide. There's different reasons that could happen. But the point is, if you wanted to treat it, if you want to refine your entries without having to go to a lower time frame, this is one way you could do it. So here you have this break, and immediately this becomes the order block. The market retraces into it, but never breaks it. So you could have had your, if you wanted to do treat this as a range and look for the premium entry, this would be your stop loss to be safe. You could put it at the top of the order block as well, but bear in mind the market can come and wick you out. That's why I would prefer to have it at the top of the swing here. And then what happens? The market pushes down from there. Look at another example again. You have this low, it gets broken. Immediately that break occurs, the last bullish candle that led to the break becomes an order block, like so. So marking the high and the low. And you stretch that out and you notice the way the market came in here, didn't quite take it out, almost did, but it was respectful, gave you a swing, turn around, pushed away from there. In this particular instance, you can see that the market had, before this order block, it also had a bullish candle here, bullish candle here. When you have consecutive bullish candles in the case of a bearish order block, or consecutive bullish candles in the case of a, when you have consecutive bullish candles in the case of a bearish order block, you can mark all of them. Consecutive meaning they follow one after another. So there's not like, oh, this is white and then this is a red one and then this is white. No, they all follow. The same thing for a bullish order block where you notice consecutive bearish candles. You can mark all the consecutive bearish candles, okay? And notice how after this break, what do you have here? If you wanted to, this is your order block here. It's a range of its own. You could, this is brand new. It's just coming to me. I'm learning it just as I'm telling you. But this is basically your entry range is what I would call it. Your range for entries, not necessarily for anything else. So halfway point, that's equilibrium, just above their premium. All right, boom, great. So you could just set a pending order here, have your stop loss there. And now what? It shits itself again and again and again. So that's about it with multiple examples of your, of your order blocks. Let's talk about fair value gaps. Now I'm going to show you one. It's a little bit messy, but it is there. So remember, this low gets broken, this candle closes. Look at this. It's very tight, but it's there. I'm going to zoom in so you can see it for yourself. All right? Just selling here. This needs to be balanced. This is what I said, where sometimes it'll just tap it, other times it will trade through it. And one thing you need to keep in mind about fair value gaps is if you have an order block followed by a fair value gap, that fair value gap is telling you that this order block here is a high probability order block, meaning it is very likely to be respected rather than broken. Why is this key? Guys, sometimes, like I said before, not everything works 100% of the time. Sometimes you will have order blocks that fail you, even on a high time frame. That's life. I need you to get used to that. It doesn't mean that you did something wrong. It doesn't mean the concepts don't work. It just means it failed, and that's fine. But in the future, that could be an interesting area for you to look for a trade in the other direction. But I've promised myself not to go too deep into that so I don't confuse you. Let's take a look here. What do we have? Another fair value gap, like so. Let's mark this out, and this here. And notice how, after this gap is formed, the market retraces into it and then rejects it. And your target could very easily be this low here. Now, this is a 5-minute chart. So I want you to imagine what it's like when you find a fair value gap on a high time frame. So this is a 4-hour chart. The Kiwi dollar, NZD USD. So if you had found this order block here, you're just waiting every four hours, checking all your charts every 4 hours to see what's going on. And then you find this. How do you trade it? Okay, let's talk about it very practically. How do you trade this? Remember, I keep saying that sometimes when the gap is formed, the market will just tap it and then move away quickly. That was the case here. Okay, so how would you have handled this? First things first, you have this 4-hour fair value gap. This candle closes here, and that's when it's formed. So you'd have an alert for the start of the FVG. FVG meaning fair value gap. Once the alert is hit, all you'd have to do now is think about. Let's go down to a lower time frame. So now I'm going to where are we? Yeah, this is M30. This would have been tricky. This is why I actually love my range bar charts, because you see this move? If you were waiting based on time, this is a 30-minute chart. If you're waiting with a time-based chart, you've missed this already. Why? Because you're like waiting for that official rejection or whatever. You could have missed it. There are ways to get in without missing it. Okay, like literally you could maybe go to a much lower time frame and wait. And even then, look at this. Look at this here. We have this low. It gets broken. If you were waiting for a retracement into this fair value gap, you wouldn't have gotten it. If you did use a bearish engulfing to get in, by the way, this, when you pair it with liquidity, this is a 4-hour fair value gap. This is when your stuff like the bearish engulfings and head and shoulders start to actually work the way you expect them to. It's not the random things, guys. If you've always wondered why exactly are these candlestick patterns that I'm being taught on baby pips not working, it's because you're taking them on from random areas that don't make any sense, and probably not with a high time frame. Okay, but I digress. So look at this here, and how would I have gotten into this? It's simple. I'll show you an example. So let's make a quick measurement just to understand how many pips this retraced. Okay, so I'm going to go to a 10 pip Renko chart. This is that same area, guys. So option number one could be, because I know that we are tapping into this fair value gap here, I could use this bar to start framing my trade. Option number two is I could wait for an actual swing formation, because the same idea about swings applies even with the Renko, guys. So this 1, 2, 3, this says a higher high. This is a swing formation. And remember, we said that just because the candle closes here doesn't mean there wasn't another push to the top side. So if you're planning to use Renkos, always keep that in mind. If you're not going to look at any other charts, give some room with your stop loss, just in case the market wants to keep pushing before it goes down. Right. So let me show you option one. This is our 10 pip Renko bar chart. This is that fair value gap that I've marked out. I'm going to lock it in place. Now I'm going to grab this here. That means all I'm doing is waiting for a bearish candle to form and close. Okay? And now I have two options. I'm going to lock this in place. And then I'm going to take you to, let's see, this is the Kiwi dollar. So I can take you to a lower time frame, my equivalent of the seconds. Hang on. It's going to involve a lot of scrolling. I don't want to do that. Let's just go to M1. It's going to take a lot of scrolling otherwise. All right. So this here, what you're looking at here, look at the top side. That was that FVG. What you're looking at here is that Renko bar. As soon as that Renko bar closed, what did it do so? It did so here. Then all I could say to myself is, great, now that you've closed, I am just going to wait for a break in market structure. A fair value gap formation, we get that here. Let me zoom in closer so you can see it. This is the 1 minute, mind you. Okay? And in this case, what happens? So we have the price pushing down here. This is the point where that 10 pip Renko bar closed. Okay, so all I'd be doing is, okay, I'm chilling, I'm waiting, I see this break in structure, awesome sauce, and this break in structure left behind this fair value gap here and this higher one here. Okay, cool, no problem, nice one. So now what can I do? Once I notice the market starts to turn around, it's option one. I could be here with a pending order, have my stop loss above here, or better yet above here, because remember, there's always a chance that when you have two fair value gaps, the market may reach into the very first one. And you don't want that. You don't want to have your stop loss too tight and then you get taken out. But what do we have here? The market, if you had a pending order, your stop loss above the high, what happens? The market retraces only how many pips of drawdown? Just about 1.5 before it starts going your direction. Okay? Alternatively, you notice this is a fair value gap, then you see that you have a swing formation, 1, 2, 3, boom. That could have been your entry. You don't like that? No problem. What happens here? You have this low, it gets broken. So what happens? This candle becomes an order block. And what did I say about when there are consecutive candles that are also bullish? You mark all of that, and what happens? The market starts to retrace, giving you, I don't know if you see it, once it starts to retrace, this is a new range. So ranges within ranges. The market starts to retrace. You're in the premium section of this 1 minute range, which is framed upon that 10 pip Renko, which is framed upon that 4-hour fair value gap. Don't forget, it's not random. So then the market does what? Pulls into the premium section of the range. What is this tiny space here? That's a fair value gap. And that's so well respected. Market rejects it. Your entry here, your stop loss here for 1.5 pips, and then you ride it. Surely, if you have a 1.5 pip stop loss and the price is pushed about 10 pips in your favor, I don't know, what are you still doing? You can get out. Okay? So let's come back to... That's one way you could have gotten into that. You could also have gotten in with a range bar chart. Let's see. So this is that area here. I'm going to delete this so that there's no confusion. No confusion. Delete. Boom. Look, even here you have this. It's not a swing low, but on some lower time frame, this is M15. On a lower time frame than M15, that is absolutely a swing. Why is it? Because the market, think about the story, turning point in price, which means, think about it, the market came from this high, this close here, pushed down, then pulled back up, then pushed down. For it to have pulled back up, that tells you, even if you can't see it here, there was absolutely a swing. And so what happens? That swing gets broken with these series of down bars, which turns this into an order block, which the market comes back to tap into. All right? So I think that's about all I have to share, except one more thing to ask you this. Think about what kind of trader you are. Okay? Is key. What kind of trader are you? Keep life simple. Number one, external to internal range liquidity. Okay? Meaning you take money outside the range to inside the range. Or number two, internal to external range liquidity, which means you take money inside the range to outside the range. And whatever you pick, you must make peace with the fact that you will sometimes miss out on opportunities. You cannot be warring with yourself over that. Okay? It doesn't make sense. It does not make sense. So look at this example. This is still M15 on the Kiwi dollar. We had this high get formed. Market pushes down, creates this low, and then starts to pull back up. Automatically, what do you have? Let me delete this. What have you now created? Or what has the price created, rather? You have a range, Remember, we said swing to swing, turning point to turning point, if you will. And now, you could be that person who just waits for the money to come outside of the range, and then you're waiting for what? A turning point. 1, 2, 1, 2, 3. 1, 2, 3, and this is key. Notice that this candle here closed below the open of this. On a lower time frame, this candle closing below the open of the previous one is a break in market structure, and I'll prove it to you so you know I'm not just saying shit. Look here. Now let's go down to, I'll say the 1 minute. Give us a moment. I have to do a fair bit of scrolling. Yeah. This is the 1 minute chart here. This is that low. It gets broken. So the price is fractal. And once it gets broken, what are you noticing? Think about it. So you had the market push down here, pull back, push down here. So you could look at this as sort of if it's pulling back and then it's pushing down. What do you have? Pushing down, pausing here, and then pushing down again. Your interest is above here, remember. So all you're doing is just looking for, okay, we have that structure break, great. This is order blocks here. Boom, market comes into it. If you don't like that, you're not sure, no problem. You can always wait for the next break. What happens here? You have a low, the market breaks all of that. Okay, cool. It's broken all of that. Now what? All of this together, order blocks. The market does not break above them and it continues to push down. For those of you who don't like to use range bars or Renkos or any of the stuff I'm showing you, the same thing applies. If you are an external to internal liquidity trader, how would this apply for you? Let's say, okay, you're noticing the market is pushing down. This is a high here. You mark it. Then the market continues to push down, pulls up, creates a new high and goes down. Okay, you cancel that alert. Now you put an alert here. Okay, the market is pushing down. Now, okay, this is we're waiting for to see if the market is going to push back up there. It doesn't. And guess what? That's life. So the thing I'm trying to heavily emphasize okay, we're back. The thing I'm trying to heavily emphasize is that you can pick one and that sometimes you will not get an entry and that's okay. Even if you're the kind of trader who looks for a pullback into a range, sometimes you won't get a pullback and that's okay. But pick one and what's going to happen is your trades will be much better. They will be so much better. And all of you to keep asking me, I keep saying this, I do not trade gold. Not because it's not tradable, but because of the simple fact that I don't like to have to recalculate when it comes to pips and the things that I use for my entries. I have this tool over here that allows me to enter into trades easily. It does not fucking matter though. It's still the same principle. This is gold right now on H4, and I do not give signals. But based on what I have taught you, you can already see here, fair value gap. How's the market reacting to that? It's the same thing. It does not matter. It's the same thing. What do you have here? This is a structure that gets broken. What is this? This is an order block here. What happens? What happens? Not only do you have an order block, you have a fair value gap. So if you were eyeing this level here on a lower time frame, you might have found something. Or let's say you were waiting for the order block to get hit, but it didn't get hit in this situation. Okay, what do? You keep waiting and now you have a swing formation. Okay, what is a swing? Turning point in price. If it's turning, what's it likely to hit? What's the next likely thing to get hit? Well, the next high. It's the same thing. I don't care what you trade. The other day we looked at Amazon. So many gaps everywhere, but it was still the same thing. It does not matter. All right, that's about it. I'm going to flip this around and then I'm going to address anybody that has actual concerns. Janie, thank you for the follow. MBTG4F, thank you for the follow. Hustle Life 101, I just answered your question. Tupac, thank you for the follow. Tash, we don't give signals here. Anybody who's taking any signals from anybody, that's up to you. Sell what to where? That what and why? We don't spoon feed here. Tash, perhaps I might be able to explain better on there. Okay, cool. Please explain. It's much better. Okay, so again, something I keep saying, which is I will never give you signals because I rob you of the opportunity to learn for yourself. I think of it as stealing. I think of it as stealing the chance for you to be confident in your own self and your own ability to analyze a chart. It's stealing. Guys, life can literally be this simple. Let me show you the chart. This is why I love range charts. Life can be this simple. Let me show you. Hang on a sec. I need to change this so it's easy for everyone to see first. Reduce that brightness. Life can be as simple as, what's that trade I got into today? It was GBP JPY actually. And you can find that on my chart, on my page. My most recent post was about GJ. So I'm taking you to a range 50 bar chart. We have to wait for it to populate. Life can be as simple as, if you don't even want to analyze too much, no problem. You don't care about what the trend is coming from, no problem. Just know that if you're not looking at the trend, you may have a bit more losers than needed, but that doesn't mean you won't make money. It could be as simple as this. This is a 50 pip range bar chart. It's bullish. This bar closed bullish. Great. Now I'm going to set an alert at the 50% point. The 50% point gets hit. Let me put a line there to delineate that. Hold on a second. Let's grab our horizontal line, sorry. Okay? And then I say to myself, all right, cool, bet. I'm going to go to a lower time frame, and I'm going to look for a reason to get into this trade. Excuse me for a moment. This is it here. This is the moment that 50 pip range bar chart closed. Now I'm looking. What is it exactly that lies just below 50%? What do we notice here? This got broken. You have a fair value gap here. You have another fair value gap here. And if the market was going to take off without you, okay, you see 1, 2, 3 swing formation. And then by this bar, I would know for sure, okay, we're ready to go. Life can be that simple. It can be that simple. You don't need signals. I don't know how to explain this any better to say you don't need signals. When this bar closes, I could just set an alert and say, okay, I'm waiting for you to retrace into 50%. But it doesn't do that. No problem. Okay. It goes on to push this new bar, and I'm like, all right, fine. Now I'm setting alert for 50% of you. And what happens here? This is the trade I took today. All I did was I went straight from here to the 30-minute chart. This is that range. So I noticed that we have this fair value gap here. And then what happens? The market trades into it 1, 2, 3. This is a swing rejection. This is a swing that has formed. What is the swing? The turning point in price. What is this turning point hinged upon? A fair value gap. And based upon the premise that I'm thinking the market should continue to the top side, based upon the premise that this fair value gap is in the discount portion of the range. 1, 2, 3, boom. I didn't see when it traded into here. When I came around, it was somewhere around here. And then I got in. And it was that simple. So, all this to say, you don't need signals, you need confidence in yourself. And you cannot develop that confidence if you keep looking for signals and someone's feeding you with that. It's sad. Freddie Black, I see you. Thank you very much. Thank you for helping me out. I appreciate you. Richland Empire, thank you so much. Is it ICT strategy? It's not ICT strategy. It's ICT story about price, which is liquidity. Basti Parfait, check our Telegram channel, but else you'll say you don't need the mentorship. Yeah, so you don't need the mentorship. If you cannot afford it, that's fine. And anyway, actually, it's the end of the month. I have closed. Yes, thank you for that reminder. So I'm going to take down that post. I'm not dealing with anybody apart from the one person who has already paid. So because I only have so much energy. I come live most days, Mondays to Fridays. Fridays, we're going to talk about psychology. Mondays through Thursdays is the charts. Jesse, link on our bio. How much do your mentorship, please? So like I just said, I'm no longer taking anyone on. Sorry. I'll open it up end of next month probably. I am new and I want to start trading. Go to babypips.com, babypips.com. /learn. It's free. You don't have to do anything. Thank you guys for the follows. Thank you for the likes. I appreciate you guys. Just scrolling through the comments to see what we're missing. Freddie, I appreciate you. Thank you so much for helping. Thank you so much. Litter Eliminator. I love your name. I don't know what is that about, but yeah, you're very welcome. You're very welcome. Sean Hype, Defriend Ways, Ayataka, 95%. Thank you very much for the follow. Soldier Super Sniper 2, Juma Pro, thank you for the follow. Odogu Billions, hello Nasa, please, I want to be your student, so kindly check your DM. I don't close. My messages are being blocked. What are you typing? Certain things are, if you are mentioning money, I know that's going to get blocked. I set that up on purpose because some people here, they just come and type stuff and put themselves in trouble, or they're trying to scam people. So maybe you're typing a word. It normally comes back if it's not hit fully. So again, in the comments, anybody teaching you anything, that's fine. But if I didn't say it, I didn't say it. Don't come and ask me about things I didn't say. Don't ask me about things I didn't say. That's all I'm going to say. Where can I get to know more about this trade? What trade? I mean, trading in general? Anyway, let me look at the more recent messages. LSG The Voice, thank you for the follow. I appreciate you. Rian Digital Moneymaker, bless you so much for putting that link in there. Basti Parfait, you are very welcome. You are very welcome. I thank you for being here as well. MBTG, and expensive. Facts. Signaling gets you lazy. Very lazy. Can you put a download option so I can rewatch your video, please? I will upload this particular one because I actually said new things here today. Jesse, thank you. Seti, thank you for the roses. God's love, thank you for the roses. FBI, thank you for the follow. Yada yada, thank you. Thank you for the follow. You guys are amazing. Dlamini Sabelo 600, thanks for the follow. Freddie, thank you so much. You are helping me out, man. Do you believe in being profitable while lacking money? As how? Okay. Do you believe in being profitable while lacking money? What does that mean? What I always say is treat your demo, even if you don't have the money now, treat your demo like a live. Fund it with an account with an amount that you know realistically you would fund your account with. If you are planning to do the prop firm route, go and study the rules very carefully, and then when you're trading your demo, trade it with those rules in mind. Okay? You absolutely can be. You can be profitable. It's a matter of time. Guys, you need to start looking at things like being broke or poverty, whatever. It's a phase. It's a phase. And I highly, highly believe in, not just believe in, know about the law of assumption. So you need to start making assumptions about yourself that will help you. Just make the assumption that when you are ready, the money will flow to you. You will be able to trade with it. Okay? That's key. That is key. Now, we talk about some of these things during psychology. That's the parfait, come again and again. You get the gist of repetition. Yes, absolutely. Absolutely. Happy New Month, Ladinus Man. Yes, Happy New Month indeed. And that's key, guys. Please go to your monthly charts. Interesting things may have occurred. Go to your monthly charts, mark the highs and the lows of the last month. Look within the range of the last month to see areas that might be interesting and set your alerts. Okay? For those of you who like long-term trades, definitely check it out. I like to check the monthly chart out at the start of the month, end of the month, and in the middle. Hang on a sec. Are we live? Can you hear me? Starting to think there's something going on over here. That's weird. Let me check and see. Yeah, my data's working just fine. Okay, guys, so if you're still here, if you can still hear me, I'm going to take off now. Thank you for being here. Thank you for your presence. Thank you for your attention. And may the markets favor you in all you do. I think I've gone off, but that's fine. I'm just going to upload this to the YouTube. Alrighty, bye. That's weird. Okay, so apparently my network went off there. Diana DeFrey, hi, it's nice to see you again. LSG The Voice, you're very welcome. Sorry, I went off. I hope you guys heard me. Yes, 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 yes. Okay. What's up about NFP? I don't trade news. I don't trade news. I look at my news calendar only to see, okay, this is what's coming, when it's coming, and I don't want to be in the market then. I'm really confused on where to start now. Go to, I don't know if you're still here, Jesse, because my network went off for a bit, or at least it froze on my end. Go to babypips.com/learn. Hey, Freddie, thank you. Thank you so much. Thank you. Okay, so I've seen I didn't really miss a lot. I struggle to set alerts, honestly. Do not miss why. They'll help you and they'll set you free, actually. They'll set you free. Alerts are so good. They'll set you free because you could just walk away and come back. So there's two alerts for me. Number one is when I've marked my range, I set them where I'm interested in. So sometimes I will switch from going inside to outside to inside. So in that case, either way, if I'm going inside to outside, I'll set my alerts at just below 50% if I'm buying or just above 50% if I'm selling. If I'm going from outside to inside, then I also need to have my alerts on for the close of each bar. Okay? Donnie Ree, I'm not sure if I'm pronouncing that right, but you're very welcome. You're very welcome. What is today? Friday. Oh, yeah, psychology. Okay, guys, that's about it. So now that I'm sure that I have not missed anything with you, I'm going to take off. Thank you so much for your time. Thank you so much for your patience, for your presence. I appreciate you. As much as I have given to you, you've also given to me by being here. I adjure you to please be a skeptic. Don't just take everything that I've said at face value. Go and check your charts yourself to be sure that everything I share is accurate. Because in the process, you will show yourself what it is I've been talking about, and that's how you develop your confidence. I am always a big, big fan of skeptics, especially the skeptics that go out to look for information for themselves. Do not swallow everything I say hook, line, and sinker. I'm a stranger for all you know. I could be talking shit. I will never DM you first. If anyone's DMing you first claiming to be me, it is not me. Please don't get scammed. The Telegram link is in the bio, but TikTok will not allow you to open it here, so just copy the link and then paste it in your browser. And that should get you into the group if you want to. Those of you who want my YouTube channel, it is youtube.com/at I take ticks. You can go ahead and also copy the link from my Telegram if it's my TikTok if it's still there. If it's not there, again, it's still I take ticks on TikTok. What else is there to talk about? That's pretty much it, I guess. So no, I will not be touching on Wyckoff. So, Armstrong, you missed the start of the live where I said that everything that I do is about simplifying what it is I already know. And everything that I'm teaching is not my concept, it's ICT by Michael Huddleston, Inner Circle Trader, ICT, whatever you want to call him. It's not my original concept, but what I've done is I've stripped it down to the basics to make it simple. I don't like Wyckoff. I think it is subjective. I tried to look at it once many years ago and I decided it was not for me. And I will not be complicating things by throwing that in the mix. By the way, those of you who join the group, if you join the group and you start talking about other strategies, I am very quick to cap that shit because I am dedicated to helping people simplify. And I cannot vouch for what I do not know. And I will not be one of those people who claims to know shit that I don't know. If I don't know, I don't know. I don't care. YouTube link at I Take Ticks, youtube.com/ at I Take Ticks. Turn it off already. Odogu Billions, thank you very much for the subscription. I appreciate you, and I hope that the content on there helps you. Send the video of how to set an alert. Vusi, this would depend on your platform. Some things are Googleable. Google it. The stuff I can show you, and then there's stuff where you can take the initiative. It's also a good thing to be able to take the initiative for yourself to look up certain things, because that's how you're going to grow. It's not just based on me teaching you everything. All right? Just look it up, because if you're using setting alerts could be different depending on what platform you're using. MT5, CTrader, TradingView, NinjaTrader, I don't know. So look it up. Bullet A. Well done. Well done. NZD USD has just been a darling, honestly. Jay, thank you for the follow. Classic Home Finishing, thank you for the follow. Precious Egbe, thank you for the follow. Odog Billions, I will check my DM. Although I said it's closed though. Okay, people, I'm going to go now. Everyone take care. Have a good day. I will download this particular live and upload it to the YouTube channel in case you missed it. Tomorrow's Friday. Please be safe with your trading. Remember to check the news and the times. Don't get caught unawares. And may the pips be with you, and may the markets favor you. And I'll continue to see you as a master trader until you finally see yourself that way as well. Good night.